With the price action in gold that we've been seeing, how are you keeping sane and how are you trying to make sense of it all?
Well, the first thing I tell my subscribers, and I tell myself really, because really I'm really talking to myself and I'm talking to my subscribers, is that first of all, I don't know everything. And I don't know daily price movements. I don't know weekly price movements. I don't even really know monthly price movements. All I know for sure is that gold is money. The dollar is a money substitute, and money substitutes are inflated up the wazoo, and they are in the process of dying. And we can see that through all the shortages that are coming through all the angles of the economy that we think of, especially in raw materials and energy, and this is happening. So how I keep sane is I make sure I have a level of cash. And no, I'm not a fan of fiat cash or dollars or anything, but I understand that. And I've been through this several times already. I've been a gold bug and a gold analyst since I discovered Ron Paul in 2011, 2012. So it's taken me almost 10 years to come to terms with these emotional realities. But in order to keep your sanity, especially in times like these, when gold goes down, in times when we would expect it to just skyrocket up, you need cash. You need to have that emotional stability to tell yourself that when it goes down in times when it doesn't make sense to you or anybody with any modicum of knowledge of the monetary system for real, that you need to be able to buy the dip. Because if you can't do that, you'll be thrown out of the game, especially if you're on leverage. So the way I keep sanity is months ago when I saw that the bullish news of, let's say the Democrats winning both the House and the Senate, and we knew that they were going to spend money until, the end of the world, or however you want to say it. It wasn't bringing gold to new highs. So I started getting out of core positions until I had a certain level of cash. It doesn't mean that I was liquidating everything, not by any stretch of the imagination, but making sure that if we go into another liquidity crisis, which we've seen in 2008, we've seen it in 2020. We even saw it in 2000, with the dot-com crash, which took 2 years to play out. And every time it happens, it happens more extreme and quicker and in less time. So the question is there going to be another liquidity crisis? My answer is yes. But at some point, the liquidity crisis is going to lead to rising gold, which it did in the late 1970s instead of falling gold. The question that we're all asking ourselves is the next liquidity crisis going to lead to a 2020 type crash or a 1978 to 1980 type explosion? And anyone who says that they can answer that question for sure and they know the answer is fooling themselves, because we don't know. We need that cash to be able to buy the dip in case there's another, there's another temporary deflationary liquidity crisis, which I'm pretty sure will be even more extreme and take less time than it did in 2020, which was about 2 weeks. It might be a week, because how long really is it going to take the Fed to step in this time? They've already got their fingers on all the triggers and they're ready to do everything, even in a day or two. It's not going to take long, but you've got to have the cash to be ready for it.
So when we're thinking about not only gold, but let's say proxies for gold, are you seeing some selling exhaustion in the leading miners?
I was yesterday. In Newmont and Barrick. Those are the ones that I'm following most closely, and those are my biggest positions. I don't think it's any secret to give that out, because it's conservative, makes sense. I don't take any crazy risks or anything on explorers or anything like that. I do have some positions in them, but I try to be rational, and it's very rational to be most focused on these two miners because they're the biggest ones in the sector. So yesterday I saw some selling exhaustion in Barrick and Newmont. And what we can be sure of is these two companies are doing very well. Newmont a little bit better than Barrick, and I'm more biased to Newmont. But they have stable dividends. They're making money. Their stock prices can go down. Obviously, we've seen it before. And when they do, their dividends are not going to go down. I don't think that either of these companies are going to cut their dividends anytime soon, because the gold price is what, 1720, 1730 now. And it's these companies are profitable even at like $1,600, $1,500 gold. They're in no danger of any type of financial problems or anything like that. So my thought is that when there is selling exhaustion, the institutional players, when they want to start into this sector, they're going to go into those two stocks first because there's nowhere else for them to go. These are the highest liquidity stocks, and these are the ones that should reverse first. And we saw a little bit of buying exhaustion yesterday. Now we're seeing a little bit of reversal. It can go up and down until we get to a final bottom. Exactly when that is, I can't tell you, just like nobody can. But those are the two stocks I'm watching for that sign, and it's going to come.
So just a little bit for some perspective, we're speaking on the afternoon of the 29th.
Right.
But what is the gold to commodities ratio also kind of telling you at this time, Rafi?
So that's interesting. The gold to commodities ratio, that will tell you how many units of a commodity index, let's say the CRB or the GNX or whatever commodity index you want to take, how many units of commodities you can buy with 1 ounce of gold. And we are now in the midst of, since when oil hit what it was, negative $35 a barrel in April 2020, and everybody thought that was impossible. And anytime before April 2020, you would have said, of course it's impossible. Oil can't go to negative $35 a barrel, and we all saw it. So from that point on in financial insanity until now has been the biggest correction of gold in commodity terms since we went off the gold standard. It ties with the 1975, 1976 correction in commodity terms. And, to say that this is a record is not that much of a stretch, considering that we're counting it from when oil was negative 35. So yeah, from that point until now, to say that gold has fallen in commodity terms in the strongest way since 1975 is definitely true. And if you were trading in the 1970s, or you look into that history, Nixon went off the gold standard finally in the last phase of it was 1973. We have this number in my 1971, which is true, but from 1971 to 1973, Nixon tried to put gold back on a set dollar exchange rate. And the last one was 42.22, I think, in 1973. And then we had the 1974 to 1976 bear market in gold. And you can look back at that time, and you can look at how gold was performing in commodity terms, and it was just as bad as it is now. And it ended in 1976, I think August 23rd, 1976. And from that point, gold really started outperforming commodities. And from 1976 to 1980, we all know what happened. Gold went up about an order of magnitude, and that's what we're all waiting for, because we're waiting for the world to give up on the dollar, or at least to understand that the purchasing power of the dollar as it is now is impossible, which is very reflective in the fact that shortages are showing up everywhere, because all commodity markets are priced in dollars. And if every commodity is in shortage, not every single commodity, but a lot of them, especially, for example, gas in the UK, there's shortages of natural gas in the UK. There's I think cotton prices are at 10-year highs. All these things are showing up everywhere, and it should be that higher prices cure higher prices and bring things back into balance, but they are not. Right? So we're at a point where we're in the mid 1970s, which made no sense. Why should gold fall from 1974 to 1976? It doesn't make any sense, but it did happen. So the fact that it's happening now, it doesn't make sense fundamentally, but markets don't always go by fundamentals. That's just something you have to accept as a trader. If you're the kind of person who just, focuses on his job and puts money away in gold every month and doesn't look at it, you don't have to worry about any of this stuff. Fine. But we're not in that business. We're just not. So we have to understand that fundamentals do not always push markets alone. And we're in one of those times, like in the mid 1970s. But the other thing we have to realize and we have to internalize and understand as traders is that this is going to end. This correction is going to end. And in order to get through it, you need to have the cash to have that mental stability, because we are all human beings and we're all affected by our emotions. And instead of denying them, we have to embrace them and understand them and figure out a way to stay rational in the face of them.